Hi dear. Welcome to Trader's Mind Code. How to day trade for a living. A pro trader's daily routine and risk strategy. Chapter 1. The truth about day trading. The term alone sparks a wide range of emotions, from excitement and ambition to fear and skepticism. To many, it represents financial freedom, the ability to make money on your own terms, and the glamour of working just a few hours a day. To others, it's a dangerous game played by gamblers and thrill seekers. But what is the truth about day trading? This chapter aims to strip away the myths, expose the realities, and prepare you mentally for what lies ahead on this journey. Day trading is not a get-rich-quick scheme. It's a profession, and like any profession, it demands discipline, strategy, and relentless practice. Point 1.1 The fantasy versus reality. The fantasy. You've probably seen the social media posts, traders sitting on a beach with a laptop, sipping an espresso while watching five-digit profits roll in from one single trade. They sell the dream, freedom, wealth, ease. The reality. The truth is far less glamorous. Real day traders work in silence, often alone, hunched over multiple monitors, analyzing data, calculating risks, managing emotions, and refining their edge over months and years. The success rate in day trading is low, with studies suggesting that only 5% to 10% of traders are consistently profitable. But here's the part most people overlook. Those who succeed treat day trading as a serious business. Point 1.2 What day trading really is. Day trading involves buying and selling financial instruments within the same trading day. It can include stocks, options, futures, forex, and even crypto. Unlike investing, where you ride long-term trends, day trading focuses on short-term price movements, often using technical analysis and high-speed decision-making. Key traits of day trading: speed. Decisions must be made within seconds or minutes. Volatility. Traders capitalize on rapid price movements. Liquidity. High-volume instruments are preferred to enter and exit trades swiftly. Risk management. Small losses are common and must be controlled. Strategy-driven, random. Trades lead to ruin. Systematic approaches lead to longevity. Point 1.3 Common misconceptions. Myth 1. You need a finance degree or background in Wall Street. Truth. Many successful traders come from non-finance backgrounds. Engineers, teachers, programmers, and even artists. What they share in common is a disciplined mindset and the ability to follow a proven process. Myth 2. The more trades you take, the more you make. Truth. Overtrading is one of the most common reasons traders fail. Quality over quantity wins in day trading. Sometimes, the best trade is no trade. Myth 3. You can start with $100 and turn it into $100,000 in a year. Truth. While small accounts can grow, expecting exponential growth with no experience is gambling. Realistic returns are modest in the beginning. Survival is the first milestone. Profitability is the next. Point 1.4 Who is day trading for? Day trading is not for everyone. It's for those who thrive under pressure, can make fast decisions with limited information, are self-motivated and comfortable with solitude, understand that losses are part of the game, value freedom, but are willing to earn it through discipline. You don't need to be a genius, but you do need to be mentally tough, highly focused, and willing to unlearn bad habits. Point 1.5 The psychological toll. One of the biggest truths about day trading is the mental pressure it places on you. Every trade triggers emotions: hope, fear, greed, frustration. Without psychological discipline, even the best strategies fail. A losing streak can wreck your confidence. A winning streak can make you overconfident and reckless. This is why 90% of the game is mental. If you don't learn to master your emotions will master your account. Point 1.6 The skill pyramid. Success in day trading sits atop a pyramid of three core foundations: knowledge, chart patterns, technical analysis, volume, candlesticks, execution, entries, exits, risk management, hotkeys, platform mastery, psychology, patience, discipline, emotional control, resilience. Most beginners focus too much on the top layer, getting into the perfect trade. Pros focus on the bottom, building rock-solid habits. Point 1.7 The business mindset. Treat day trading as a business, not a hobby or side hustle. Just like any business, you have capital, your trading account. You have tools, charts, brokers, scanners. You have expenses, platform fees, losses. You need a business plan, trading strategy, journal, rules. Approach it like a professional, and you'll be surprised how far that mindset alone takes you. 1.8 the time commitment, while some traders spend just a few hours trading each morning. A full-time trader's day doesn't end when the markets close. The after hours involve reviewing trades, studying charts, updating journals, preparing for the next day. Learning to day trade successfully can take 6 to 18 months of dedicated practice. There are no shortcuts, but with consistency, the rewards are real. 1.9 the reward of mastery. So why do people still pursue day trading? Because for those who do master it, the rewards are incredible. Freedom to work from anywhere. Independence from a 9 to 5 job. High income potential with low overhead. Deep personal growth and discipline. Day trading forces you to become your best self. It punishes arrogance and laziness and rewards humility, discipline, and effort. Few professions offer such direct feedback and personal growth. 1.10 the final word. Know what you're getting into before you dive in. Ask yourself, are you prepared to fail before you succeed? Can you handle losing money and coming back the next day? Are you willing to do what most won't, to live how most can't? If your answer is yes, you're in the right place. This book will guide you from the foundations to the fine-tuned techniques of a pro trader. But it starts with honesty. Know the truth, accept it, and get ready to work, because day trading isn't easy, but it's worth it. Chapter 2. Getting started. The trader's mindset before the charts, before the strategies, and before the profits. There is the mind. Your mindset is the control center of your trading decisions. It determines how you respond to risk, how you handle losses, how you manage discipline, and ultimately, how far you go in this career. You can have the best trading strategy in the world, but without the right mindset, you will sabotage your own success. This chapter will take you deep into the mindset of a successful trader, how they think, how they act, and how they build. The mental toughness to endure and grow in the markets. 2.1 Trading is a mental game. Day trading is 20% strategy and 80% psychology. Most traders lose not because they don't know what to do, but because they fail to do what they know. The market doesn't just test your skills. It tests your patience, discipline, and emotional control. 3 Mental enemies of every trader. Fear freezes you from entering good trades or forces you to exit too early. Greed makes you overstay trades, risking profits for just a little more. Ego pushes you to revenge trade, break your rules, or avoid admitting mistakes. Mastering your mindset means learning to recognize these emotions in real time and acting despite them. 2.2 The difference between a gambler and a trader. To the untrained eye, trading can look like gambling. Fast decisions, uncertain outcomes, big gains or losses. But the difference lies in the mindset and process. A gambler trades for excitement, acts on impulse, and measures success by single outcomes. A trader operates on a tested system, acts on probability, and measures success over a series of trades. Gamblers chase action. Traders chase consistency. You're not here to gamble. You're here to build a skill-based business rooted in discipline, data, and decision-making. 2.3 Patience. The hidden skill. New traders think success means always being in a trade. In reality, the best traders often sit out, waiting for the right setup. Patience separates pros from amateurs. A good trade may only come a few times a day. The market rewards those who wait, not those who chase. Ask yourself, am I trading because the setup is right, or because I feel bored or pressured? Discipline is doing nothing when nothing should be done. 2.4 Emotional detachment. Trade the chart, not your feelings. To trade well, you must detach emotionally from every outcome. Your trades are not reflections of your worth. A red trade is not a failure. A green trade is not a validation. Detach your ego from the results. Your job is to follow your plan, not to be right. Don't celebrate wins too much. Don't dwell on losses too much. Stay neutral. Stay grounded. Your mindset mantra. Next trade. Clean slate. 2.5 Discipline is a muscle you won't always feel disciplined. Some days, your emotions will try to hijack your rules. That's where routine comes in. Building a strong mindset starts with systems and habits. Pre-market routine. Prepare your watch list, plan your trades, visualize execution. In trade discipline, stick to your risk parameters. Use stop losses. Follow entry criteria. Post-trade reflection. Journal what went right, what went wrong, and what you felt. Discipline is a daily decision, not a personality trait. The more you act with discipline, the stronger it gets. Point 2.6 Resilience. Bounce back like a pro. You will lose. You will make mistakes. You will have bad days. The question is, how quickly do you bounce back? Resilient traders don't spiral after a red day. They reflect, reset, and return. They don't get attached to one trade, one day, or even one week. They trust the long-term process. You must develop the mindset to endure, especially when it feels like nothing is working. Point 2.7 The beginner's advantage. Learn without pressure. When you're new, your goal is not to make money. It's to develop your edge. Here's the mistake many beginners make. They risk real money too soon, chasing profits instead of progress. That creates emotional pressure, fear, and poor decision-making. Trade in a simulator. Learn the mechanics. Practice discipline. Track performance. In this stage, your greatest advantage is freedom from financial pressure. Use it to build habits instead of chasing results. Point 2.8 Cultivating self-awareness. Every trader is different. Some are aggressive, others are conservative. Some thrive on fast scalps. Others perform better with slower setups. To succeed, you must know your risk tolerance, your emotional triggers, your trading personality. Self-awareness allows you to build a trading style that fits you, not someone else. Keep a journal. Note your emotions. Recognize patterns. The more you understand yourself, the more consistent you become. Point 2.9 Your identity. As a trader, stop thinking like a dabbler. Start thinking like a pro. That shift starts with identity. You're not trying out trading. You're a professional in training. Professionals show up prepared, even on bad days. Follow structure. Improve continuously. Respect risk. Like a business owner respects cost. Whether you're still on a demo account or trading small size, show up like you're managing a $1 million fund. That mindset creates future results. Point 2.10 The mindset formula for long-term success. To build a resilient trading mindset, focus on this simple formula. Awareness plus discipline plus adaptability equals trader's edge. Awareness helps you identify what's working and what isn't. Discipline helps you execute your edge consistently. Adaptability helps you evolve with changing market conditions. Every trader you admire, every mentor you follow, every consistent pro, they all have this formula wired into how they operate. Closing thought. Think like a pro before you trade like one. Mindset is not optional. It's not something you develop after you make money. It's the foundation of every successful trade, every profitable week, and every long-term career. You can learn strategies from books, but mindset, that has to be trained day by day. So, before you ask, what strategy should I use? Ask yourself, am I thinking like a trader? Because success doesn't start with charts. It starts in your mind. Chapter 3. Tools of the trade. Success in day trading isn't just about mindset or strategy. It's also about using the right tools. Professional traders operate with precision, and just like a surgeon needs the right instruments, a trader needs a high-performance setup to compete in today's fast-moving markets. In this chapter, we'll walk through every essential tool you need to build your trading workstation, from hardware and software to platforms and data feeds, so that when the market opens, you're equipped to trade with confidence and efficiency. Point 3.1 The trading station. Your command center. Your trading station is where every decision gets made. It should be fast, clean, and optimized for real-time execution. Hardware checklist. Computer. A reliable desktop or laptop with fast processing power, i7 or higher recommended. At least 16 gigabytes RAM for multitasking, charting software, scanner, browser. SSD storage for quick boot and load times. Monitors. Multiple monitors allow you to track different stocks, time frames, and tools simultaneously. Start with 2 monitors, one for your charting platform, the other for watch lists, news, and scanners. Advanced traders often use 3 to 6 monitors for optimal visibility. Internet connection. High-speed wired internet, fiber preferred, with at least 100 megabits per second download and upload. Avoid trading on Wi-Fi. Stability is more important than speed. Use a backup mobile hotspot in case of outages. UPS, uninterruptible power supply, prevents shutdown during a power cut. gives you time to close trades safely or switch to a mobile platform. Point 3.2, choosing the right broker. Your broker acts as the bridge between you and the market. It's critical to choose one that offers fast execution, low commissions, or direct routing, short selling capabilities. Pre-market and after-hours trading access. Types of brokers: direct access brokers. Pro traders use these. Fast order execution, full control over routing. Advanced platforms. Examples: Lightspeed, TradeZero, Cobra. Interactive brokers. Retail brokers, more user-friendly but limited for serious day trading. Examples: TD Ameritrade, eTrade, Webble. Great for beginners. Key features to compare: order execution speed, commission structure, margin rates, and buying power. Routing options, ability to choose ECNs. Level 2 data availability, always prioritize execution quality over aesthetics. Point 3.3, charting and technical analysis platforms. Your charting platform is where you'll analyze price action, indicators, and volume behavior. Choose one that's clean, fast, and customizable. Popular platforms: TradingView, cloud-based, excellent for multi-device access. Strong for technical analysis, scripting, and sharing charts. Thinkorswim, TOS, free through TD Ameritrade. Deep tools, customizable indicators, solid paper trading features. DOS Trader Pro, preferred by professional traders for speed and reliability. Integrated with brokers like CMEG, Cobra, and interactive brokers. MetaTrader, for Forex, widely used for Forex day traders. MT4 and MT5 offer automation tools. Ensure your platform offers candlestick and bar charts, drawing tools, trend lines, support/resistance, Fibonacci, indicator library, moving averages, RSI, VWAP, MACD, etc. Multi-time frame viewing, real-time data. Delayed data won't work for intraday trading. 3.4, scanners and screeners. Time is everything. A real-time stock scanner helps you identify potential trades as they happen. You'll scan based on volume spikes, price action, float, volatility, and gap percentages. Top scanning tools. Trade Ideas, industry standard for real-time scanning. Customizable filters, AI-based suggestions, and real-time alerts. Benzinga Pro combines news and scanners. Good for finding catalyst-based trades. Finviz, free for swing/pre-market scans. Ideal for pre-market screening and basic scans. Thinkorswim Scanner, integrated scanner for TOS users. Custom scriptable filters. Set up your scans based on gappers, stocks gapping up/down pre-market. High relative volume, float size. For volatility, price range, based on your trading style. News catalyst, earnings, press releases, analyst. Upgrades, 3.5 level 2 and time and sales. Level 2 shows the order book, real-time bids and asks, including market makers and ECNs. Time and sales shows actual transactions, printing every executed trade. Together, they offer insight into momentum, strength, and market intent. Why it matters: spot hidden resistance or support, confirm breakout or breakdown strength, detect spoofing or manipulation. Learning to read level 2 and TNS is a skill, and one of the most powerful tools for a serious trader. Point 3.6, hotkeys. Speed equals survival, milliseconds matter. Hotkeys allow you to enter or exit trades instantly, set stop losses or limit orders without using a mouse, reduce emotional hesitation during trades. Most platforms, like DOS Trader Pro and TOS, allow customizable hotkey setups. Train with them in a simulator until they become second nature. Hotkeys can prevent slippage, increase confidence, and improve reaction speed. Critical for scalpers and momentum traders. Point 3.7, news feeds and catalysts drive volatility. Earnings reports, press releases, FDA announcements, analyst upgrades. These can create explosive intraday moves. Best news tools: Benzinga Pro, real-time audio squawk, alerts, and filters. Twitter/X, follow verified news sources and financial journalists. Briefing.com, institutional grade updates. MarketWatch/Yahoo Finance, free but delayed. You can also use economic calendars, e.g., Forex Factory, to track FOMC meetings, CPI data, jobs reports, Fed speeches. Knowing when and why a stock is moving gives you the confidence to trade it. Or avoid at point 3.8 journaling tools. Journaling is not optional. It's your trading microscope. Documenting each trade allows you to spot patterns in behavior, track what works and what doesn't, improve emotional awareness. Journaling tools. TraderSync, Edgewonk, TraderView, Excel/Google Sheets. Custom. Track. Entry/exit points. Setup type risk. Reward screenshots of charts. Mental state during the trade review weekly. Growth lives in the data. Point 3.9 simulators. Practice without pressure. Never risk real money until you've proven consistency in a simulator. Recommended simulators. DOS Trader Simulator, Thinkorswim, Paper Money, TradingView, Replay Mode. Trade ideas. Simulated trading. Use them to test strategies, train hotkeys, practice execution without emotion. Aim for consistency over time before going live. A green streak in simulation doesn't mean you're ready. Stability and discipline are the real benchmarks. Point 3.10 backup tools and mobile trading markets are unpredictable. So is technology. Always have backup. Mobile trading app from your broker. Alternative internet source, hotspot, phone support number for your broker. Watch lists synced across platforms, TradingView, TOS Cloud, etc. When your desktop fails, your phone can be your lifeline to close trades and manage risk. Chapter 4. A day in the life of a pro trader. The life of a professional day trader isn't about making impulsive bets or staring at charts for 10 hours a day. It's a refined, repeatable process, a structured routine designed to reduce emotional decision-making, maximize focus, and extract consistent performance from the markets. In this chapter, we'll walk through a full trading day through the eyes of a professional trader. You'll learn the rhythms, the rituals, the setups, and the critical moments that define success, not just once, but every single day. Point 4.1 The power of routine. Most people imagine day traders waking up late, casually jumping into trades, and logging off early with piles of cash. That's fiction. Real traders follow a strict routine. They treat trading like a business, because it is. Routines provide structure in an otherwise chaotic market. They protect you from emotional trading and reactive behavior. They allow you to trade with intent rather than impulse. 4.2 Morning. Preparation begins before the bell. Alarm clock, 5:30 a.m. to 6:30 a.m. Mindset and physical warm-up. Wake up early. Hydrate. Light movement or stretching. Quick journaling or meditation to set a calm, focused tone. Review affirmations or past successes to build confidence. Pro tip: trading is a mental sport. Like an athlete, warming up your mind and body matters. Chart increasing 6:30 a.m. to 7:30 a.m. Market scan and news feed. Check global markets, Asia, Europe, for overnight sentiment. Review macro news, economic releases, earnings reports, pre-market movers. Use scanners to identify gappers, high-volume stocks, or news catalysts. Begin building your watch list, 3 to 5 stocks with a potential setup. Key filters: relative volume, over 1.5x average, price gap, up or down at least 2 to 5%. Recent news, or earnings float. Size and ATR, average true range. Direct hit goal, filter the noise. Focus only on stocks with a clear catalyst, range, and liquidity. Brain 7:30 a.m. to 8 a.m. Strategy planning. Mark key support and resistance levels on charts. Define entry zones, stop-loss levels, and profit targets. Decide on strategy type per ticker, breakout, pullback, reversal, etc. Write down your trading plan. Yes, on paper or digital notes. Pro tip: plan the trade before you trade the plan. Clarity now prevents chaos later. Point 4.3 Opening bell. Execution under pressure. 9 o'clock, 8 a.m. to 9 a.m. Pre-market trading, optional. Some professionals trade pre-market if the volume is high and spreads are tight. Others avoid it due to lower liquidity and erratic behavior. If trading, size small and tighten stops. Loudspeaker 9 a.m. to 10 a.m. Market open chaos. The first 15 to 30 minutes are the most volatile of the day. Stick to your watch list. Avoid chasing. Only take trades that meet all criteria from your plan. Execute using hotkeys for speed and consistency. Stick to max risk per trade and maximum daily loss limit. Common trades: opening range, breakout, momentum continuation, VWAP, bounce or rejection gap, fill, reversals, emotional discipline. Take a deep breath before each trade. Never average down. If you hit your loss limit early, stop trading. Locked with key golden rule. The first 60 minutes are for trading. The rest of the day is for managing and learning. Point 4.4 midday. Protecting profits and staying sharp. 12 o'clock, 10 a.m. to 11:30 a.m. Trade management and review lock-in profits. Tighten stops. Trail winners carefully. Avoid revenge trading if you're in the red. Stop trading if setups become low quality or you feel emotionally unstable. Mental checkpoint. Am I sticking to my rules? Am I trading from emotion or logic? Is the volume drying up? Prohibited 11:30 a.m. to 1 p.m. Midday doldrums. This is often the choppiest, lowest volume time of the day. Most pros take a break, lunch, a walk, or exercise. Avoid overtrading during slow market conditions. Pro tip. Taking time away preserves mental capital for the next session or next day. Point 4.5 afternoon. Calm observation or strategic entry. 3 o'clock, 1 o'clock p.m., 2:30 p.m. Optional secondary sessions. Some stocks set up for afternoon breakouts, breakdowns, or VWAP reversals. Trade only if volume returns and a setup is clean and high probability. Size down. Focus on precision over quantity. Pros approach. Afternoon trading is about opportunity, not necessity. No trade is better than a bad trade. Point 4.6 close. Data, review, and growth. 4 o'clock, 2:30 p.m. to 3:30 p.m. End of day routine. Close all positions unless swing trading, rare for day traders. Screenshot every trade you took, entry, exit, chart. Write a post-trade journal. What worked? What didn't? What did I feel before, during, and after each trade? Was it part of my edge? Key metrics to track. Win rate, risk-reward ratio. Average hold time, daily P&L, emotional triggers, direct hit goal. Improve 1% each day. One trade, one habit, one insight at a time. Point 4.7 after hours. Mastery never stops. 5:34 p.m. to 5 p.m. Post-market scan and journaling. Review market movers for tomorrow. Reflect on behavior, not just results. Study charts, even ones you didn't trade. Ongoing practice. Backtest new strategies. Watch trade recaps by mentors. Revisit losing trades to find blind spots. Point 4.8 key habits of a pro trader. To summarize, a pro trader's day is defined by discipline, structure, and self-awareness. Here are daily habits that create long-term success. Wakes up early and prioritizes mental clarity. Prepares a defined, written trading plan. Trades only A-plus setups within their strategy. Reviews, journals, and reflects daily. Respects risk over reward. Ends the day with a focus on growth, not just profit. 4. 9. What pro traders don't do. They don't chase hype or alerts blindly. They don't trade to make back losses. They don't break rules after a losing streak. They don't let one day define their self-worth. They don't treat trading as a side game. It's their craft. Closing thought. Trade your plan. Live with purpose. A day in the life of a pro trader isn't built on adrenaline. It's built on calm repetition, structure, and self-control. There are no shortcuts to mastery. But if you build a day around intention and follow that process with consistency, you won't just trade better, you'll live better. You are your routine. Design it wisely, then follow it with conviction. Chapter 5. Developing a solid trading strategy. In trading, strategy is everything. Without it, you're guessing, you're reacting, you're gambling. But with a strategy, you're operating from a plan, guided by rules, not emotions. You know what setups you're looking for. You know your entry, your exit, your risk, and your edge. And when a trade fits your criteria, you act, not because of a gut feeling, but because it aligns with a proven system. This chapter is your blueprint for building a solid trading strategy, one that fits your style, maximizes your edge, and evolves with your experience. Point 5.1. What makes a strategy solid? A solid trading strategy has 5 essential elements. Clear setup criteria. You know exactly what to look for. Defined entry rules. No hesitation. You know when to enter. Stop loss parameters. Your risk is capped before the trade even begins. Profit target/exit rules. You know when and how to take profits. Backtest data. You've proven it works before risking real capital. That if you can't explain your strategy to a new trader in under 2 minutes, it's too complex or not defined well enough. Point 5.2. Strategy versus edge. A strategy is a plan, but a trading Edge is the reason that plan works. Your edge is what gives you a statistical advantage in the market, whether it's a pattern you've mastered, a specific time of day, or a behavioral tendency of retail traders. Example: a breakout strategy isn't an edge unless you can consistently find breakouts before they happen, with a higher than average probability of follow dash through to build your edge. Study market behavior, your own trade data, common patterns that repeat over time. Your edge sharpens. Your strategy evolves. But it starts with a solid base point. 5.3. Choosing a strategy type that fits you. There are countless strategies, but here are the most common day trading styles. 1. Momentum trading, buying breakouts or shorting breakdowns as volume surges. Ideal for fast markets and volatile stocks. Requires strong discipline to avoid chasing. Point 2. Reversal trading, fading extended moves when signs of exhaustion appear. Riskier but rewarding with precise timing. Tools: RSI, volume divergence, support/resistance zones. Point 3. VWAP strategies, using the volume-weighted average price as a mean reversion or breakout indicator. Often used in midday or slower sessions. Point 4. Opening range breakout, ORB, trading. A breakout from the first 5 to 30 minutes price range. Best for high-volume gappers and catalysts. Point 5. Scalping, small, rapid trades for a few cents profit per move. Requires tight spreads, lightning fast execution, and strong focus. Point 6. Pullback. Trading, entering after a short retracement during a trend. Safer than chasing breakouts. Combines momentum with patience. Choose a strategy that matches your risk tolerance, your personality. Fast versus slow thinker. Your available screen time, your comfort with volatility. 5.4. Anatomy of a basic strategy. The breakout setup. Let's break down a common beginner-friendly strategy. The high of day breakout. Setup criteria: stock has gapped up in pre-market. Volume is above average. Clear resistance level. Intraday high is forming. Entry trigger: price breaks above the intraday high with volume confirmation. Stop loss: below VWAP or last pivot low, low risk buffer zone. Profit target: 2:1 risk reward minimum. Partial out at +1R, trail stop for the rest. Tools used: 1-minute and 5-minute charts, volume indicator, VWAP pre-market highs, and intraday resistance lines. This strategy works because you're trading with momentum, supported by liquidity and a catalyst, such as news or earnings. It's simple but highly effective when followed with discipline. Point 5.5. Backtesting and data validation. Before you trade any strategy live, you need proof that it works. How to backtest: use replay tools, TradingView, TOS on demand. Go back 3 to 6 months of charts. Mark every time the setup appears. Track win rate, average gain/loss, max drawdown. Key metrics to log: setup name, entry/exit points, stop loss level are multiple. Risk reward, outcome, plus or minus. Market condition: if your setup wins at least 50% of the time with a minimum 2-to-1 reward to risk ratio, you have a working edge. Point 5.6. Risk per trade. The core of strategy execution. A strategy is only as strong as your risk control. Define max risk per trade, e.g., $50 or 1% of account. Max loss per day, e.g., 3 red trades or $200. Daily goal, optional, but keep it modest. Use these to stay consistent. Never increase size mid-session. Never remove stop losses. Never revenge trade after a loss. Consistency beats size. Small wins, repeated with discipline, grow into big progress. Point 5.7. Journaling, strategy-specific trades to refine your strategy. Track every trade with setup-specific tags. Over time, patterns emerge. Which setups work best on Monday mornings? Which have low success in choppy conditions? Which require larger volume to confirm? Your trading journal becomes your strategy lab, an evolving map of what's working and what needs tweaking. Point 5.8. Strategy evolution. From one to master. You don't need 10 strategies to succeed. You need one that you understand deeply, one you can execute without hesitation. Master that first. Only after consistent success, 30 to 50 trades with positive expectancy, should you consider adding another. Grow vertically before growing horizontally. Point 5.9. Strategy checklist. Before every trade, here's a simple pre-trade checklist to confirm your setup. White heavy checkmark: is this a strategy I've backtested and understand? White heavy checkmark: does the setup meet all my criteria. White heavy check mark, am I within my risk parameters? White heavy check mark, is the market condition favorable for this strategy? White heavy check mark, am I calm and focused, not chasing or reacting? If the answer to any is no, skip the trade. Point 5.10. The final word. Strategy is your anchor in the chaos of the market. A solid strategy is your anchor. It's what keeps you grounded when emotion wants to take over. It's your edge when others are confused. It's your blueprint for consistency. Your mission is not to trade every opportunity. Your mission is to execute your strategy with discipline, trade after trade, day after day, until you don't just know the setup, you become it. Chapter 6. Risk management like a pro. If trading were a game of survival, risk management would be your shield. It doesn't matter how smart you are, how accurate your chart reads are, or how many green days you've had. If you don't manage risk like a professional, the market will eventually wipe you out. Pro traders know one absolute truth. You don't need to win every trade. You just need to avoid losing. In this chapter, we'll break down how to control risk like a seasoned trader, protecting your capital, managing losses, and building the consistency necessary for long-term success. Point 6.1. The mindset of risk. First, profits. Second, most beginners enter the market asking, how much can I make? Professionals ask, how much can I lose? And can I live with that? This shift in thinking is what separates sustainable traders from gamblers. That a winning trader knows small losses are normal. Big losses are unacceptable. Protecting your account is more important than chasing gains. Risk management isn't about fear. It's about staying in the game long enough to let your edge work. Point 6.2. The 1% rule. Your first defense. The 1% rule is a foundational concept for risk control. Never risk more than 1% of your total trading capital on a single trade. So if your account is $10,000, the most you should lose per trade is $100. This rule prevents emotional decisions, keeps damage small during losing streaks, forces you to use stop losses and calculate position sizes logically. Even 5 losing trades in a row will only cost you 5%. Manageable and recoverable. Point 6.3. Calculating position size the right way to trade responsibly. You must size your position based on risk, not on account size or gut feeling. Position size formula. Position size equals max risk per trade. Trade risk per share / text. Position size equals /frac / text. Max risk per trade / text. Trade risk per share. Position size equals trade risk per share. Max risk per trade. Example. Account size $20,000 risk per trade, 1% $200 entry price, $10 stop loss, $9.50 trade risk, 50 cents per share. Position size $200 / 50 cents equals 400 shares. Pro tip. Adjust your share size before you take the trade, not after you've entered. Point 6.4. Stop losses. The professional safety net. A stop loss is your predefined exit point if a trade goes against you. Point 2. Common types. Hard stop. A programmed exit order, automatic. Mental stop. A manual exit level, more flexible, but riskier. Always place your stop just below key support, if long, or above resistance, if short. Outside the normal price noise, but within your max loss threshold. Never move a stop further away once the trade is live. Doing so turns a small loss into a potential disaster. Point 6.5. Risk-to-reward ratio. Are the profit equation. A solid trade offers at least a 2-to-1 risk-to-reward ratio, meaning you aim to make $2 for every $1 you risk. This ensures you can be wrong more than half the time and still stay profitable. Your winners outweigh your losers over time. Example. Risk $100 target, $200 R equals 2-to-1 even with a 40% win rate. A 2-to-1 ratio keeps you net profitable. Pro rule. Never take a trade with a reward smaller than your risk. Point 6.6. Daily max loss rule. Protecting your mental capital. Just as each trade has a risk limit, your day should too. Set a daily max loss limit, typically 3x your risk per trade. If you risk $100 per trade, stop for the day. If you lose $300, why? You protect your account. You prevent tilt and revenge trading. You live to fight another day with a clear head. Discipline equals longevity. Point 6.7. Avoiding the blow-up. The red flags blowups happen when traders ignore risk controls. Watch for these red flags: increasing size after losses, revenge trading, trading without stops, averaging down into losers, chasing trades to make back losses, trading emotionally after a big red day. Professional traders understand that capital preservation is the foundation of opportunity. You can't trade if you're out of the game. Point 6.8 Psychological risk management. Risk isn't just numbers. It's emotional and mental energy. Managing psychological risk means taking breaks after a loss or emotional spike, journaling to release pressure and learn, staying detached from outcomes, practicing meditation or breath work if stress builds up. A calm trader is a dangerous trader because they act with clarity that don't just protect your capital, protect your confidence. Point 6.9 Scaling inverses. All in. There are two ways to enter trades. All in entry, one full position at entry point. Simple and fast, but risk is concentrated. Scaling in, enter in pieces as confirmation builds. Reduces risk exposure early. Increases precision, especially on volatile names. Pro traders often scale in and out, using core and add remove techniques based on price action. Point 6.10 Risk in your strategy. The bigger picture each strategy you use should define your entry and exit logic, your average risk per setup, your risk-reward potential. If a strategy consistently risks more than it makes, refine or retire it. Don't fall in love with a method that drains your capital. Test every strategy against your risk parameters. Does it fit your 1% rule? Does it offer at least 2:1 R? Can it survive 5 losses in a row without wiping out 10% of your account? Only data-backed, risk-conscious strategies earn a place in your system. Point 6.11 Risk control tools and features. Use tech to enforce discipline. Hotkeys for stop orders and exits. Risk control features in your platform, e.g., max loss limits, alerts. For support/resistance breaches, journal tools like TraderSync, Edgewonk. To track risk stats, the best risk system is automated, consistent, and emotionless. Point 6.12 The power of compounding protection. Here's the truth no one tells you. It's not the big winners that make you rich. It's the avoided big losses that keep you in the game. When you control risk, your drawdowns are shallow. Your capital can recover faster. You build confidence from consistency. And as you scale, your edge compounds safely. Closing thought. Risk is the business cost of trading. Professionals never eliminate risk. They manage it ruthlessly, like insurance companies or casinos. They know the game is about probability, not perfection. The goal isn't to avoid losses. It's to make sure no loss can take you out. So protect your capital. Respect your risk. Follow your plan, because the trader who survives wins. Chapter 7. Psychology of a consistent trader. Consistency is the holy grail in trading. Not once in a while wins, not streaks, but predictable execution over time, regardless of the market's mood or your emotional state. Trade consistently. You must first think consistently. That means developing mental patterns that override fear, greed, and ego. It means learning to stay neutral when others panic, focused when others freeze, and disciplined when others deviate. In this chapter, we dive deep into the psychological framework of a professional trader. You'll learn the habits, beliefs, and internal systems that separate consistent traders from emotional ones. 7.1 The mental game of trading. The biggest battles in trading aren't on the screen. They're in your head. You're not competing against Wall Street. You're not fighting other traders. You're wrestling with your own impulses. The urge to chase green. The fear of missing out, FOMO. The pain of a red day. The greed to stretch a winner beyond your plan. Consistency only emerges when you learn to observe your emotions without obeying them. Until you make the unconscious conscious, it will direct your life, and you will call it fate. Carl Jung. 7.2 Emotional discipline over emotional reaction. Every trader experiences emotions, but professionals are defined by how they respond, not how they feel. How amateurs react. FOMO leads them to enter late. Fear causes premature exits. Ego makes them ignore stops. Greed lets them overtrade. How pros respond. Acknowledge emotions without reacting. Pause. Breathe. Refocus. Return to the trading plan. Pro traders don't chase feeling right. They chase being disciplined. Point 7.3 The identity shift. From dabbler to trader, consistency begins with identity. Ask yourself, am I treating trading as a hobby or as my profession? Professionals follow routines with discipline. Accept losses without shame. Learn from every mistake. Focus on execution, not outcome. This identity shift is everything. Once you think like a pro, your behavior starts aligning with success. Point 7.4 Handling losses like a professional. Losses are inevitable. How you frame and process them determines whether you evolve or collapse. Don't personalize losses. A red trade doesn't mean you're bad. It means your setup didn't work this time. Don't spiral. One bad day doesn't define your career. Don't seek revenge. Emotional trades are your fastest route to a blown account. Instead, log the loss. Identify the lesson. Let it go. Consistent. Traders move forward without emotional baggage. Point 7.5 The danger of overconfidence. Ironically, winning can be more dangerous than losing. If you become careless after a hot streak, you increase size impulsively. You ignore stops because I'm on fire. You overtrade, believing you can't lose. This leads to blow-up behavior. Pro traders stay humble. They respect the market, win or lose. They know that consistency comes from repeating process, not results. Confidence without humility leads to complacency. Point 7.6 Building patience. The trader's superpower. Patience is a trader's most underrated skill. Waiting for your A-plus setup. Sitting on your hands when the market is choppy. Holding winners according to plan. Letting your strategy play out over months, not days. Consistent traders aren't in a rush. They understand. You make your money in minutes. You earn it by waiting hours. Train your mind to wait with purpose, not boredom. Point 7.7 Mental capital. Your invisible currency. Every decision costs you mental energy. Watching too many tickers? Burnout. Taking too many trades? Fatigue. Fighting the market all day? Emotional depletion. Pro traders protect their mental capital by keeping routines simple, taking breaks, journaling to release emotional weight, knowing when to walk away. Trading is an energy game. Protect your mind as fiercely as you protect your account. Point 7.8 Developing unshakable focus. Distractions are deadly. One lapse in focus can cost you a day's profit or more. Stay consistent. Trade in a clean, quiet environment. Eliminate phone/social media during active hours. Use noise-canceling headphones or concentration music. Trade fewer setups, but watch them deeply. Focused attention equals faster learning plus fewer mistakes. Point 7.9 The power of detachment. The best traders trade with detachment. Detachment from outcomes. Detachment from ego. Detachment from perfection. This doesn't mean they don't care. It means they don't get attached. Your job is to execute your process, not to be right every time. Let go of needing a green day. Let go of the need to impress. Let go of the scoreboard. When you stop needing the trade to work, you start trading better. 7.10 Rituals that build psychological strength. Elite traders build psychological resilience through daily rituals. Morning routine, breath work, affirmation, or visualization to center yourself. Pre-trade checklist reinforces process over impulse. Midday reset. Step away to clear your mind during slow periods. Post-trade journaling, reflection, and emotional processing. End-of-week review. What did you learn? What patterns are repeating? These rituals aren't nice to have. They're performance systems. Consistency is built one ritual at a time. Point 7.11 Red flags. Mindset traps that derail you. Watch for these warning signs. Chasing revenge trades after a loss. Hesitating on entries that fit your plan. Feeling entitled to green days. Fearing the market instead of trusting your edge. Overanalyzing and missing opportunities. Each trap signals that your psychology needs realignment. Catch it early. Reset. Recalibrate. Point 7.12 Consistency isn't boring. It's power. Some traders fear that routine and discipline will make trading feel robotic. But here's the truth. Repetition breeds confidence. Confidence breeds clarity. Clarity breeds results. The consistent trader knows each day isn't about fireworks. It's about stringing together solid decisions again and again. The compound effect of emotional control, process discipline, and routine execution? It's unstoppable. Closing thought. Master yourself. Master the market. The consistent trader isn't the smartest or the fastest. They are the most self-aware, the most disciplined, and the most aligned with process over emotion. If you want to win in trading, master your mind before you master the market. Because once your psychology is in sync with your process, consistency isn't a dream, it's a habit. Chapter 8. Journaling, Data, and Growth. You can't grow what you don't track. In trading, your journal is your mirror. It reflects your strengths, exposes your weaknesses, and captures the raw truth of your performance. Every professional trader understands this. Journaling isn't just a record, it's a feedback loop. It's how you turn scattered experiences into structured insight. And it's how you move from random wins and losses to deliberate progress. In this chapter, we'll explore the vital role of journaling, the power of trade data, and how you can use both to accelerate your evolution as a trader. 8.1. Why journaling is non-negotiable. Journaling gives you a bird's-eye view of your trading behavior. It answers questions that your emotions often distort. Am I following my strategy? What setups are most profitable? What mistakes do I keep repeating? How do I feel before, during, and after trades? Without a journal, every mistake is forgotten. Every insight is lost. With a journal, every day becomes a lesson. Your journal is your silent mentor. 8.2. What to track in your trading journal. A powerful trading journal captures both data and psychology. Core data points: date and time of trade, ticker symbol, trade direction, long/short, entry price and exit price, stop loss, and take profit, position size, result, P&L in dollar and R multiple, trade context, setup name/type, breakout, reversal, VWAP, bounce, market condition, trending, range-bound, news-driven, strategy used, according to your playbook, mental and emotional tags, confidence level before trade, emotional state during trade, fear, greed, calm, hesitant, overconfident, reason for entry and exit, was it based on plan or emotion? Immediate thoughts after the trade, bonus, add a screenshot of the chart at entry and exit. Visuals add critical context during review. 8.3. Tools for effective journaling. You can journal with a simple spreadsheet or use a dedicated platform. Manual journals, Excel/Google Sheets, highly customizable. Notion/Evernote, good for combining notes and charts. Physical trading notebooks, digital journal platforms. TraderSync, clean interface, auto import from brokers, tags, and analytics. Edgewonk, deep analytics, strategy optimization tools. TraderView, detailed trade breakdowns and performance summaries. ChartLog, broker integrations and trade visualizations. Whatever tool you choose, consistency is key. It's better to journal daily in a simple spreadsheet than occasionally in a complex app. 8.4. The weekly review ritual. Once a week, typically over the weekend, review your journal. This is where the real growth happens. Ask yourself, which setups had the highest win rate? Which trades broke my rules? Did I respect my risk management parameters? Were there emotional patterns influencing outcomes? Look for best time of day for your trades, worst trading habits recurring, e.g., chasing, over trading. High confidence setups worth scaling. This is how raw trades become refined strategies. 8.5. Monthly metrics. Measure to improve every 30 days. Pull your data into a performance snapshot. Track win rate, percent, average R multiple per trade, profit factor, total gains divided by total losses, max drawdown, risk reward, consistency, setup-based performance. These metrics give you an objective view of progress beyond day-to-day emotions. They show where you're improving and where you need to refine. Example, setup A, 68% win rate, average R, 1.8. Setup B, 40% win rate, average R, 3.2. Setup C, 55% win rate, average R, 0.9. Cut it or fix it. Now you're not guessing. You're optimizing. 8.6. Turning mistakes into improvements. Every red trade contains a gift. If you study it, use your journal to identify patterns. Do your losses happen when you deviate from plan? Are you trading well early, then forcing trades midday? Are emotional decisions more frequent after a green streak? Once identified, set a corrective action. I will trade no more than 3 tickers per day. No trades after 12 p.m. unless high volume. I will review my trading plan before each entry. This turns mistakes into microevolutions. Point 8.7 Growth beyond the P&L. True growth in trading is internal before it's external. Your journal isn't just a performance tracker. It's a personal development tool. Track your discipline score. Rate yourself 1 to 10 each day. Emotional control, clarity of thoughts, self-talk, and mental framing. Write affirmations or reflections. Today, I followed my plan regardless of outcome. I remained calm during volatility and trusted my edge. I sized down after a red streak to protect my capital. These habits shape the trader you're becoming. Not just the P&L you're posting. Point 8.8 The compounding power of review. Think of journaling like compounding interest. Each insight builds on the last. Each review deepens your self-awareness. Each refinement increases your edge. Over 3 months, 100+ trades and hundreds of data points reveal who you really are as a trader and how to become who you want to be. Without journaling, this data dies. With journaling, this data compounds. Point 8.9 Common mistakes traders make with journaling. Only journaling green days. You lose the lessons from your red days. Tracking too much, too soon. Simplicity leads to consistency. Skipping chart screenshots. Visual context is everything. Never reviewing the journal data without review is wasted effort. Avoid perfectionism. Focus on consistency. Point 8.10 Journaling as a growth system. Ultimately, your journal is more than a document. It's a system. It creates a loop. You trade. You reflect. You adapt. You trade better. That's how amateurs become professionals. One trade, one entry, one honest review at a time. Closing thought. Build the system that builds you. The market doesn't owe you anything, but it offers everything, to those willing to study themselves. Journaling is how you stop repeating mistakes. Data is how you sharpen your edge. Review is how you evolve. That if you want to grow, don't just trade. Track, analyze, improve, repeat, because your greatest edge isn't in a setup, it's in how well you understand yourself. Chapter 9. Scaling your trading career. You've built a foundation. You've mastered your edge. You're trading consistently, managing risk, and journaling your evolution. Now what? It's time to scale. Scaling your trading career isn't just about increasing size. It's about expanding your capability, discipline, and performance ceiling without compromising the systems that got you here. This chapter will guide you through the process of growing your trading business, step by step, so you can move from solid part-time results to full-time professional income and beyond. Point 9.1 What does it mean to scale in trading? Scaling isn't about gambling with larger size or chasing bigger wins. It means increasing position size while maintaining your risk ratio, trading with more capital but the same discipline, evolving from retail survival to professional execution, turning consistent monthly profits into compounding wealth. Scaling is gradual, intentional, and data-backed. You don't scale because you want to. You scale because your system proves you're ready. Point 9.2 The prerequisite. Consistency first, size second. Never scale a broken system. Before you scale, your strategy must be tested over 100+ trades. You must maintain a positive expectancy, more money made than lost. You must respect your risk parameters even on red days. You must journal and review consistently. If you're profitable at small size but still breaking rules, scaling will only magnify your mistakes. Pro tip. Scaling without psychological readiness leads to fear, hesitation, and blow-ups. Point 9.3 Gradual position size increases. The safest way to scale is through incremental position increases. Scaling formula. Example. Current trade size, 100 shares. Risk per trade, $50. Win rate, 60%. After 30 trades with positive performance, increase to 120 to 130 shares. Only increase size if you're executing with the same emotional discipline at current size. Warning signs you scaled too soon. Hesitation to enter trades. Moving stop losses out of fear, letting small losses turn into big ones. Avoiding trades altogether. Size should not change your process. If it does, go back down. Scaling must feel like a natural extension, not a leap. Point 9.4 Scaling with capital. Growing your account. Once you have consistent profits, reinvest a portion of your profits into your account. Compound growth over time through controlled leverage and sizing. Example, $10,000 account grows to $15,000. Increase your per trade risk By 1% of $15,000 equals $150, let the capital scale your system, not your emotions. Point 9.5 transitioning from part-time to full-time. Going full-time isn't about the money. It's about the process stability. Checklist before you go full-time. At least 6 months of consistent profitability. A proven strategy with a clear edge risk management system in place. Daily stops, max loss. Minimum 6 to 12 months of living expenses saved, personal and financial support systems, family, insurance, etc. Ask yourself, can I emotionally handle full-time pressure? Am I confident trading live without external income? Do I have a routine that supports long-term focus? If yes, you're ready to take the leap. But start small and treat it like the business it is. Point 9.6 business mindset. Trading as a professional enterprise. Professional traders view trading as a business operation, not a personal hustle. That means keeping clean books and tax records, tracking performance like a business P&L, investing in tools, technology, and education, managing risk like a CFO, making decisions based on data, not desire. Build a process for monthly income goals, quarterly reviews, annual performance audits. Tax compliance. Track expenses, commissions, platform fees. Your career is not just trading. It's running a one-person hedge fund. Point 9.7 scaling strategies. Width versus depth. There are 2 ways to scale your edge. 1. Depth scaling. Same strategy, bigger size. Master one setup and grow position size over time. Easier emotionally because you know the pattern inside out. Point 2. With scaling, multiple setups or markets, add more strategies, e.g., scalping plus swing plus VWAP fade. Or explore new markets, futures, options, crypto, forex. Increases opportunity, but requires more complexity and discipline. Scale depth first, then add width later when your system is stable. Point 9.8 managing psychological pressure as you scale more. Size equals more money. More money equals more pressure. More pressure equals more temptation to break your rules. Common mental traps when scaling. Performance anxiety. Now I have to win. Identity attachment. I'm a full-time trader now. I can't lose. Over-optimization. I need to trade more to hit my targets. To stay sane, keep your daily risk fixed, no matter your account size. Follow your routine religiously. Meditate, journal, and debrief weekly. Never confuse account growth with self-worth. Your job stays the same. The numbers get bigger. Point 9.9 building a long-term career. Vision. Scaling isn't just about the next few trades. It's about designing a life through trading. Ask yourself, what lifestyle do I want my trading to support? How many hours per day? Am I willing to trade long-term? What kind of income target feels realistic and sustainable? Do I want to expand into coaching, content, or a fund? Some pro traders stay lean, trading solo with flexibility. Build small private trading groups or communities. Launch YouTube or mentorship brands. Diversify into investing or automation. That you're not just scaling your trades. You're scaling your identity and impact. Point 9.10 sustainability systems for scaling to maintain performance as your capital grows. Use automated stop loss and hotkey systems. Delegate non-trading tasks, admin, taxes, content, etc. Keep journaling and backtesting as part of your weekly process. Use trading breaks to reset your emotional and mental capital as the stakes rise. Your systems must become more refined, reliable, and repeatable. Closing thought. Grow slowly to grow forever. Scaling your trading career isn't a sprint. It's a methodical evolution, built on the same principles that gave you your first green month. Don't rush. Let your data, your discipline, and your psychological strength be the foundation for growth. Because real traders don't scale to look impressive. They scale because they're ready, because their process is proven, and because they respect the craft enough to grow the right way. Chapter 10. The Longevity Mindset. Day trading isn't a get-rich-quick scheme. It's a high-performance career, a mental sport, a craft that to last in this game. Through bull markets and bear markets, hot streaks and dry spells. You need more than strategy, more than skill. You need a longevity mindset, a deep commitment to sustainable success, driven by discipline, balance, and self-awareness. In this final chapter, we explore what it takes not just to win in trading, but to keep winning for years to come. Point 10.1. Trading is a marathon, not a sprint. New traders are often obsessed with speed. How fast can I make $1,000 a day? When can I quit my job? How soon until I double my account? But the pros think differently. How can I trade well for the next 10 years? How do I avoid burnout? How do I keep evolving with the market? The long-term trader isn't chasing intensity. They're building consistency. Because consistency, compounded over time, becomes freedom. Point 10.2 The three pillars of trading longevity. Longevity isn't accidental. It's built on three core pillars. 1. Mental durability, mastering emotional discipline, bouncing back from drawdowns. Without revenge, trading, staying calm during volatility. 2. Physical health, energy management for long screen hours, prioritizing sleep, nutrition, hydration, and exercise, preventing burnout and fatigue. 3. Strategic adaptability, evolving your strategies as markets change, updating your edge, tools, and routines, never becoming complacent. Traders who last treat their body like a machine, their mind like an asset, and their strategy like a living document. Point 10.3 Build a life around trading, not just through it. The most dangerous mindset in trading is obsession without boundaries. Yes, passion drives success, but obsession without balance leads to tunnel vision, isolation, burnout, diminishing returns. Longevity means designing a life structure that trading fits within, not the other way around. Set working hours and stop trading after your session. Ends, take scheduled breaks and vacations. Create time for family, fitness, hobbies, and mental resets. Trading should enhance your life, not consume it. Point 10.4 Health is an edge. No amount of strategy can overcome physical burnout. Trading demands cognitive sharpness, reaction speed, focus, and endurance. Your health is your hidden edge. Daily health habits for longevity. 7 to 8 hours of sleep for cognitive clarity. Morning movement, walk, stretch, light training, hydration. Throughout your session, nutritious, brain-friendly food. Avoid sugar/caffeine spikes. Post-trading, wind down to reset the nervous system. Performance equals energy plus focus plus discipline. You can't trade well if you feel drained, distracted, or unstable. Point 10.5 Avoiding burnout. The invisible enemy. Burnout often arrives silently. You don't notice it until you're forcing trades that aren't there. You're emotionally flat. Even on green days, you feel anxiety. Just opening the platform to prevent burnout. Reduce screen time when you're not trading. Limit the number of trades per day. Accept days with no trades as part of your system. Take monthly breaks or half days. Unplug fully during weekends. Burnout kills accounts, routines, and confidence. Guard against it like you guard your capital. Point 10.6 Evolve with the market or fall behind. Markets change. Setups stop working. Volume shifts. Algorithms adjust. New strategies emerge. Traders who refuse to adapt eventually get left behind. Ways to stay evolving. Review journal data every month to find what's working. Test new strategies during slow seasons. Stay connected with trading communities. Invest in education and coaching. Analyze institutional behavior and tech trends. A trader's edge isn't fixed. It's forged, refined, and rebuilt over time. Point 10.7 The power of pause. Rest is part of the routine. Just as professional athletes use recovery to stay elite, traders need intentional rest cycles. You don't need to trade every day to stay sharp. In fact, stepping away improves your clarity and conviction. Create a rhythm. 1 to 2 full off days per week. 1 week off every quarter. Quiet hours after trading. No screens, no charts. Longevity equals recovery plus rhythm. Point 10.8 Emotional recovery after losses. You will have losing streaks. That's the nature of the game. But what matters is how you recover. Pro traders after drawdowns reduce size temporarily, revisit their core strategy and best setups, refocus on process over outcome. Journal what they learned from the experience, disconnect from P&L identity, and return to execution. Losing is part of winning. What separates pros from amateurs is that pros don't let losing define them. Point 10.9 Trading with purpose. The deep anchor. The most consistent traders aren't just trading for money. They're trading with purpose. Whether it's freedom, family, mastery, or service, that deeper why keeps them grounded. When your goals are to get rich quick, to escape pain, to prove someone wrong, you burn out fast. But when your goals are to create sustainable freedom, to live life on your terms, to become world-class at a craft, you build systems that support long-term resilience. Your why fuels your longevity. Clarify it. Protect it. Revisit it often. Point 10.10 Legacy thinking. Beyond. The P&L. What will your trading journey stand for? A few good years? Or a career you're proud of? Will you teach others? Build a community? Share your lessons with the next generation? Longevity includes legacy. When you zoom out, you stop fixating on today's win and start building a career that matters. Trade not just for income, but for impact. Closing thought. Master the long game. The market doesn't reward those who flash brilliance. It rewards those who stay. The trader who wins the long game is steady when others are shaken, sharp when others are sloppy, grounded when others are greedy. The built systems. Guardrails. Routines. A mindset of resilience to SO. As you close this book, remember, it's not about how fast you grow. It's about how long you can thrive. Because in the end, it's not the boldest or the luckiest who last. It's the most prepared, the most patient, the most persistent. Trade well.